Welcome back to the Deep Dive. We're here to cut through the noise and give you the core insights from complex information.
Making sense of it all, basically.
Exactly. Today, we're digging into Tesla's Q2 2025 earnings call webcast.
Right.
Our mission, as always, is to pull out the really critical stuff so you get a clear picture of where Tesla is now and where they think they're heading.
And it was quite a call. What really struck me was this blend of, celebrating current wins, but also laying out these incredibly bold, almost audacious long-term bets.
Like a real turning point.
It felt like they were signaling something significant. Yeah, a strategic shift, perhaps.
Okay, so let's ground this in the numbers first. Management called the quarter very exciting. What figures actually back that up?
Well, automotive revenue jumped 19% from Q1. That's pretty solid.
19%.
But here's the interesting part. Total deliveries only went up by 14%.
Ah, so revenue grew faster than deliveries.
Exactly. And that points towards higher average selling prices, or ASPs, likely driven by that new Model Y. It suggests maybe a bit more focus on margin over just pure volume right now.
A shift towards profitable growth, perhaps.
Could be, especially given the market. And supporting that, automotive margins did improve sequentially too.
Got it. And it wasn't only cars, right? The energy side had news.
Big news there, actually. Their energy generation and storage business hit its highest ever gross profit.
Highest ever. Wow.
Yeah, and interestingly, margins improved there too, even though deployments were slightly down.
So better efficiency then. They're making more profit on each unit.
It certainly looks that way. Suggests that part of the business is maturing, finding its footing.
Okay. But it wasn't all rosy. Operating expenses went up.
They did tick up, yeah, mostly because of continued heavy spending on AI projects.
AI compute, hiring talent.
Employee costs, depreciation on all that AI compute hardware. Exactly. It's a big investment.
Which raises that classic question, doesn't it? Balancing that R&D spend against profits today, is it sustainable?
That's the billion-dollar question, maybe literally. It signals they're playing the long game, but yeah, it impacts near-term results.
Still, despite those rising costs, they managed positive free cash flow.
Right, $146 million, which is pretty remarkable when you consider they're also planning over $9 billion in capital expenditures this year alone.
$9 billion. That's a huge amount going into future factories tech.
Absolutely monumental investment.
And wasn't there something about Bitcoin too?
Ah, yes, the volatile bit. A one-time gain, $284 million from a mark-to-market on their Bitcoin holdings.
A gain this time, but they had a loss before, right?
Exactly.
Yeah.
Just highlights how those kinds of assets can swing their results around, separate from the core car and energy business.
So looking forward, they admitted there are headwinds, legislation, tariffs.
Yep, acknowledge those near-term challenges.
But they sounded really confident long-term.
Incredibly confident. And that confidence seems rooted in those big bets. AI, robotics, energy.
So if the numbers tell us what happened, the next big question is how they plan to get to that audacious future. And it seems like the answer starts with autonomy.
Autonomy, that's the word. They see it as the core amplifier for everything else.
It's a central pillar.
Absolutely. And the big headline there was the Robotaxi launch in Austin.
Right, with paying customers, crucially.
And no one in the driver's seat. That's a massive leap from concept to actual functioning service.
And they're not stopping in Austin, are they?
Not at all. Already expanded the service area significantly there. They're talking about hyper-exponential expansion plans.
Hyper-exponential.
Their goal, and it's incredibly ambitious, is to address half the U.S. population by the end of this year.
Half the U.S. population by year end. That sounds huge.
It is, but it hinges massively on getting regulatory approvals. They mentioned the Bay Area, Nevada, Arizona, Florida as next targets.
So regulation is the big gatekeeper here.
Absolutely paramount. Each state is different. Safety is the priority, they stress that, but the ambition is to scale from tiny to gigantic very, very quickly.
And they see this FSD, full self-driving, as key to selling cars too.
They explicitly called it the single biggest demand driver. They think sales in Europe and China will jump significantly once supervised FSD gets approved there.
Because it isn't approved yet.
Not in a supervised capacity, no. So that's a major hurdle holding back potential demand in those huge markets.
And for people who already have Teslas outside Austin.
They promised a step change improvement in the autopilot experience is coming very soon, like within weeks.
Okay, that's something current owners will be watching for.
And they noted FSD adoption rates in North America are already up significantly, a 45% increase since they made the pricing more affordable with versions 12 and 13.
So better software, lower price.
Yeah.
More people are trying it out.
Seems like it. Plus, they made that bold claim again. A car on FSD is 10 times safer than one not on FSD.
10 times safer. That's a powerful argument if they can definitively prove it with data over time.
For sure. And autonomy isn't just about driving you around, it's changing how you even get the car.
The delivery aspect.
Yeah, autonomous delivery. Cars driving themselves from the factory straight to your home.
Wow.
The plan is for that to be the default in the Austin and Bay Area by the end of the year, unless you specifically opt out.
That changes the whole logistics game. Cut costs, must be more efficient.
You'd think so. And it all feeds into the economics of this robotaxi future. They mention cost targets for the purpose-built cybercab.
The dedicated robotaxi vehicle.
Right. Potentially under 30 cents per mile, maybe even 25 cents.
That's incredibly cheap compared to current ride-sharing or taxis.
It is. And they expect this to have a material impact on their financials by the end of next year.
That's soon. Okay, so it's not just a decade-away thing in their view.
Apparently not. And it's not just their cars making money.
The personal fleet idea.
Exactly. The plan is for regular Tesla owners as early as next year in the U.S. to be able to add their own cars to the robotaxi fleet.
Like Airbnb for cars.
That's the analogy they used. Your car could be out earning money for you while you're not using it.
That completely flips the script on car ownership, doesn't it? From a liability to a potential asset.
Potentially, yeah. Turns a depreciating asset into something that could generate income.
Would there be, like, standards? Your car has to be clean, new enough?
They didn't detail the specifics, but you'd have to assume strict criteria, right? Vehicle conditions, software version, maybe even the owner's driving history to ensure safety and quality across the whole fleet. Similar to Uber or Lyft standards now.
Makes sense. Okay, moving away from autonomy for a second, let's touch on the current cars. Model Y is still doing well.
Surprisingly well to some, maybe. Still the best-selling car globally, leading in several European countries. That's a strong base.
But there are headwinds. You mentioned tariffs and legislation.
Yes, and a big one is the repeal of that $7,500 IRA EV credit in the U.S. It's ending at the end of Q3.
So soon.
Very soon. They actually said they have limited supply in the U.S. this quarter because the change was so abrupt. They're urging customers to order now if they want the credit.
A bit of a scramble then. And this impacts regulatory credits too.
Yeah. Changes in emission standards are hitting those sales, which used to be a nice little revenue stream for them.
So pressure on demand and pricing from the IRA repeal. What about making cars cheaper? The lower cost model.
They mentioned production actually started in the first half of 2025.
Well, it started.
Yeah, but the ramp up is slower than expected. They seem to be prioritizing getting current models delivered before that IRA credit expires. Maximize those sales now.
A tactical move. Focus on immediate profit before the cliff, even if it delays the cheaper car.
Looks like it. They expect general availability for the lower cost model in Q4. The goal is obviously affordability, but without killing their margins. A tricky balance.
Which brings us back to tech, AI, and robotics. That seems to be the answer to margin pressure long term.
Exactly. They talked about a 10x increase coming in the FSD parameter count. 10 times. That sounds like a huge software leap.
It signals a massive improvement in capability, likely even on the existing hardware, getting more intelligence from the same silicon, essentially.
Yeah, efficient AI.
Yeah.
And then Optimus.
Yes, the humanoid robot. Version 3 was described as an exquisite design.
High praise from them.
And they predicted it will be the biggest product ever. Bigger than cars.
Bigger than cars. Why?
Because, they argue, a general-purpose humanoid robot addresses a fundamental need labor across almost every industry. Manufacturing, logistics, maybe even helping around the house. The potential market, if they crack it, is vastly larger than just transportation.
But building it requires starting from scratch.
Fundamental design from first principles, they said. Nothing off the shelf works for what they need.
And the timeline.
Prototypes this year. Scaled production next year. And the really audacious goal, 1 million units a year within 5 years.
1 million robots a year. That's colossal. Huge manufacturing challenge. Immense. And it relies heavily on their AI progress. They claim to be by far the best in the world at real-world AI.
Strong claim. They mentioned something about intelligence density. What's that?
Basically, how efficiently their AI extracts useful information from the data it gets. It's not just about having tons of data or sensors, but how smart the system is at processing it.
Like quality over quantity of data processing.
Kind of. They contrast it with competitors maybe using lots of sensors, but less efficient AI. They think their approach is closer to how a brain works understanding, not just brute force data crunching. RAM and bandwidth are the real constraints, they argued.
And their own chips are key to this. AI5.
Yeah, the AI5 chip, called a profound game changer. So powerful, apparently, they'll have to nerf it, limit its capabilities for export outside the U.S.
Limited due to export controls. That's quite something, having a chip too powerful for export.
It's a unique problem to have, isn't it? And they updated on Dojo 2, their supercomputer aiming for scale next year, equivalent to 100,000 NVIDIA H100s.
Wow. That's massive compute power.
And AI6 is already being worked on. It all feeds into this narrative of a fundamental transformation.
From cars to something else.
From a pre-autonomy world to a post-autonomy future. They're even working on a new master plan to lay out this vision. It's a complete reimagining of what Tesla is.
Okay, let's quickly shift gears to energy. Often overlooked, but sounds like it's gaining momentum.
Definitely. Strong growth, highest gross profit ever, as we said. Driven by megapack expansion for utility-scale storage and record Powerwall home battery deployments.
And they see huge potential demand for batteries.
Massive. They gave an example. Batteries could theoretically more than double the U.S. grid's annual energy output.
Double it.
By allowing power plants to run 24/7 at full capacity, store the excess energy when demand is low, release it when demand peaks. It fundamentally changes grid management, making it way more efficient and stable.
Game changer for the grid itself.
Potentially, yeah. But like the auto side, there are headwinds here too.
Tariffs again.
Tariffs are hitting costs, about $300 million expected impact, mostly in future quarters. And that big bill, as they called it, is hurting residential storage credits because they expire early.
So cost increases and reduced incentives. How are they navigating that?
Well, they said customers seem willing to absorb some of the tariff impact, suggesting demand is strong. Plus, their megapack pipeline is diverse, and solar projects often need storage, so growth continues.
Is they're building more factories in the U.S.?
Big time. Investing heavily in U.S. manufacturing. An LFP battery cell facility coming online by year-end. And a third mega factory making megapacks near Houston planned for 2026.
Domestic production helps with tariffs and supply chains, right?
That's the strategic advantage, yeah. More resilience, potentially lower costs long term.
Okay, so wrapping this all together for someone looking at Tesla,
Mhm.
What's the big picture?
It's this integrated vision, isn't it? Cars, autonomy, AI, robots, energy. They see it all connecting into this cohesive long-term strategy.
And management believes this could make them the most valuable company.
They express strong conviction, yeah. If they execute, they think they have a shot at being the most valuable company in the world. Big if, of course. Execution is everything.
And for investors watching now, what are the key things to track?
It's about milestones, isn't it? Can they hit these Robotaxi expansion goals? Does FSD get approved in Europe and China? Do we see compelling Optimus prototypes? Can they manage the IRA impact and ramp the cheaper car? These are huge, multi-billion-dollar bets.
And they see spending on AI and R&D now as essential, even if it hits short-term profits.
They framed it as the right strategy for long-term leadership. It's a clear prioritization of future potential over immediate financial results, which the market always has to weigh carefully.
And finally, there was that governance point about the CEO's stake.
Yeah, a mention of the CEO wanting more control, currently at 13%, to keep the company on what he sees as the good direction. Hoping for a resolution at the shareholder meeting, something investors will definitely be watching.
Okay. We've reached that point in our deep dive. Time for our outrageous but plausible trade idea. Quick reminder, this is purely for discussion, a thought experiment. Definitely not financial advice.
Absolutely not financial advice, just kicking ideas around.
Right. So here's the pitch. Consider a long position focused purely on Tesla's AI and robotics potential, specifically Optimus and that AI5 chip.
Okay, isolating that part of the story.
Yeah. The thesis is, forget the near-term car sales bumps or tariff issues for a moment. Look at the core tech claims. Intelligence density, an AI chip so advanced it needs nerfing for export. This suggests a potential exponential revenue stream the market isn't fully pricing in yet.
What kind of stream? Licensing?
Or what? Sales.
Could be either or both. Widespread licensing of their real-world AI stack. Or hitting that audacious target of 1 million Optimus robots a year within 5 years. The value amplification from true autonomy and general-purpose robots could be, well, stratospheric. Maybe the market is still thinking too much car company.
And the catalysts to watch for this trade. You'd be looking for things like genuinely impressive insights or demos at the upcoming AI Day at the shareholder meeting. Seeing Optimus 3 prototypes do something unexpected or highly capable. And critically, any regulatory shifts, maybe years down the line, that let that AI-5 chip run wild globally.
How would you structure such a theoretical trade?
Theoretically, maybe long-dated call options to capture that potential upside, or just a core long-term equity holding, betting on a fundamental re-rating of the company away from just cars towards AI, robotics, and energy dominance. But again, purely hypothetical.
Got it. Hypothetical thought experiment. So, wrapping up our overall look at the quarter.
Yeah, let's summarize.
Tesla's Q2 call really showed a company juggling, didn't it? Dealing with immediate challenges like legislation and tariffs, but their eyes are firmly fixed on the future, pouring money into autonomy, AI, energy storage.
That shift from pre-autonomy to post-autonomy seems very real in their minds.
It does. The potential value creation is huge if they pull it off, but execution, as always, is the massive asterisk. We're seeing the first steps: Robotaxi expanding, Optimus development, energy investments. But it's a long road.
So thinking about everything we've dug into, what really stands out most to you? How do you personally weigh those immediate, very real challenges against this incredibly ambitious, almost sci-fi long-term vision? Where does that balance tip for you over the next few years? Something to ponder.
Definitely food for thought.
Thanks for joining us on The Deep Dive. We'll catch you next time with more insights.